managing cash flow and tracking cash flow all goes back into understanding the nature of the transactions that are running through your business. And I'm not going to talk about a statement of cash flows or anything like that. I mean, that's a more formalized way to say, okay, well, this is approximately inflows versus outflows. But what I'm talking about, and this is what I feel is the more important aspect of cash flow, is again, understanding these transactions and when cash comes in and when cash goes out, and what the spread is between those, and what I can do to minimize that spread. And we use the example, for instance, of having people that perform a service, and I have to pay these people, but then I pay these people, then I invoice, and then my customer or client gets credit, and then they pay me at a certain time. And so the spread between that creates that negative-ish situation with cash flow where I'm having to pay out before I'm having to collect. And sometimes that spread may start off large, and it may shrink because you're periodically paying people, and then you're starting to collect, and that margin is starting to make up for that negative cash flow. Sometimes that may stay constant depending on what the transaction looks like. Or maybe you sell something on credit, and then you have a typical, the calculation is a day sales outstanding, or DSO, the time from when you actually make the sale to actually when the cash is in the bank. And if I'm selling a product, and maybe I don't have that many transactions because it's a big piece of equipment or something that I'm selling, then there's a time between when I send that invoice, and I recognize that revenue, and then I've incurred all my cost until the point in time when I actually get that cash in the bank. Really, what it all boils down to is knowing when cash comes in, knowing when cash comes out, managing that spread as much as you can through credit terms with vendors that are responsible for your direct cost, or providing services for you that are directly tied to your revenue, and then managing your credit terms that you give to your customers and to your clients. Now, if you are a business where a lot of your business is point of sale, that's obviously helpful because you're bringing in that money fairly quickly. I sell something, I get the money right there, but you still may have other costs that you incur before that are direct costs. If I'm a retail company and I go out and I buy something, it sits on the shelf for 90 days. There's a cost involved with keeping that on the shelf. There's obviously was a cost that I paid for that product, or I paid to manufacture that product. And then even if I get the cash right at the point of sale, there's still some carrying costs that I've had, and that affects cash flow.